Ladies and gentlemen, what's going on? It's Joel with Real Broker. And according to recent data provided by Redfin, the median sales price of a home in January was slightly above $402,000. This figure represents about a 5.2% increase in home prices compared to the same 12-month period earlier. Despite concerns and predictions about a potential housing market crash, this increase doesn't necessarily align with, that scenario. The rise in home prices, although moderate, indicate that the market has not experienced dramatic downturn some had anticipated. However, when examining the data on a month-over-month basis, there is a notable decline in home prices by 0.6% since, the previous month. This decrease, while relatively minor, was anticipated and can largely be attributed to the seasonal trends that typically influence the housing market. Such fluctuations are common and not necessarily a signal of a larger, more concerning trend in the markets. Despite the absence of a housing market crash, it's important to acknowledge the ongoing issue of housing affordability. Current prices, even with slight decrease, remain out of reach for millions of Americans. The high cost of homes continue to pose a significant barrier to home ownership for a substantial portion of the population. The figure mentioned refers to the median home price across the United States. It's just an average and it's just a bird's eye perspective on the market. Redfin's current data shows that there are 1.3 million homes listed for sale in the United States. This represents a year-over-year decrease of 3.4%, indicating a reduction of number of sellers on the market. A comparison with data from pre-pandemic periods reveal a significant shift. 5 years ago, the inventory of homes for sale were approximately 1.8 million, a stark contrast to today's figures of 1.34 million. The substantial decrease underscores the drastic change in the housing market that has undergone. For those speculating about a potential housing market crash, these statistics might not be encouraging. Generally, for a market housing crash to occur, there needs to be a significant increase in supply, meaning many sellers are needing or wanting to sell their homes, leading to a drop in prices. However, the current scenario categorized by fewer sellers contradicts this requirement. This scarcity of sellers is likely contributing the factor to the observed 5.2 increase in home prices over the past year. Let's delve into the current state of mortgage interest rates. At present, the rate for a 30-year fixed mortgage has returned to about 7%. This is a recent increase from the mid 6% range, really prompted by the latest inflation report, which caused a spike in rates. The question on many people's mind is whether these interest rates are more likely to rise or fall in the near term. The expectation is that rates will probably remain within the same range that has been observed throughout this year and the latter part of last year. The reason for this stabilization lies in the role of the Federal Reserve and its monetary policy, which plays a crucial part in influencing mortgage interest rates. The significant factor here is not the immediate actions of the Federal Reserve, but rather the market's expectations or anticipation of what the Federal Reserve's futures actions are. This forward-looking perspective is what currently drives the fluctuation and trends in mortgage rates. Let me explain. Since the beginning of the year, there has been a noticeable decrease in the rate of inflation. Consequently, markets began to anticipate that the Federal Reserve would indicate a reduction in interest rates as early as March. This expectation led to a decline in interest rates on government debt as investors adjusted their positions in anticipation of the Federal Reserve's forthcoming actions to lowering interest rates. The dynamic between interest rates on the government debt and mortgage interest rates are closely linked, with particular emphasis on the 10-year Treasury yield. This explains why initially mortgage rates declined to the mid 6% range. The decrease in the interest rates influenced by market anticipation of the Federal Reserve's policy adjustments directly impacted mortgage rates. However, during a press conference, the Federal Reserve conveyed a more cautious stance regarding rate cuts. They indicated a desire to observe several more favorable inflation reports before considering any reduction in interest rates. This announcement tempered expectations for an immediate rate cut, particularly by the March meeting, as the Fed's expressed a lack of confidence in current inflation trends to warrant such action. Subsequently, the latest inflation report, which showed inflation rates exceeding expectation, further diminished the Federal Reserve's inclination to lower rates in the near term. This unexpected inflation surge led to the reassessment of the likelihood of rate cuts in March, with the probability measured by the CME Fed Watch tool plummeting to just 6.5%. This market shift suggests that an interest rate cut in the upcoming month is highly unlikely. As a result of these developments, interest rates on government debts began to raise again. The uptick in government bond yields has a direct effect on mortgage interest rates, causing them to increase as well. The interconnected nature of these rates means the changes in the broader economic and policy landscape, such as those signaled by the Federal Reserve, have significant implications for the borrowing cost, including for prospective homeowners. If the Federal Reserve opts to maintain its current policy stance, we can anticipate minimal fluctuation in government debt interest rates. Consequently, mortgage interest rates are likely to remain relatively stable, echoing the trend observed in these recent months, things bouncing between the mid sixes to high sixes, even low sevens. This stability underpins my expectations that mortgage rates will continue to hover within the same range. Looking ahead to the latter half of 2024, there's an anticipation that mortgage rates could decline into the 6% range, or for those with a more optimistic outlook, even into the 5% range. This expectation is grounded in the Federal Reserve's projection of implementing 3 interest rate cuts throughout 2024. However, the timing of these adjustments remain uncertain, especially with initial cuts not expected in March and may also appearing highly improbable. Given these considerations, a reasonable thought would be that the first rate cut might not occur until June or even July. The forecast hinges on the Federal Reserve's actions concerning interest rates, which are pivotal in determining the cost of borrowing, including mortgage rates. As such, shifts in the Federal Reserve policy will be crucial for those monitoring mortgage interest rate trends and their implications for the housing market and the broader economy. Analyzing home sales data over the past 5 years reveals that sales figures are at a notably low level. This trend is a direct consequence of surging home prices coupled with rising interest rates, which together have made homes less affordable and resulted in fewer transactions. Traditionally, data indicating migration patterns show significant movement away from certain parts of the states towards other. There is a considerable exodus from states like California and New York, as well as various central states, Kansas, Oklahoma, South Dakota. Meanwhile, Florida remains the top destination for many relocators. Other states seeing an influx of new residents includes Arizona, Nevada, Tennessee, North Carolina, South Carolina, among many others. This migration trend highlights the shifting preferences and priorities of individuals and families across the country. Now, examining prices for the current year reveals that elevated mortgage interest rates have led to a decline in demand, as higher borrowing costs have made it more challenging for many individuals to afford home purchases. Consequently, there are fewer buyers in the marketplace. Despite this reduction in demand, national home prices have continued to rise on a year-over-year basis. This persistent increase in prices is primarily due to the limited number of sellers, illustrating the classic dynamics of supply and demand at play here in the housing market. Several leading institutions have made their predictions regarding the housing market for this coming year. CoreLogic anticipates a 2.5% increase in home prices. Fannie Mae forecasts a 3.2% rise, while Goldman Sachs projects a more substantial growth of 5%. Conversely, Moody's predicts a slight decline of 8.4%, and Morgan Stanley expects a 3% decrease in home prices. The Mortgage Bankers Association is a little bit more optimistic, expecting a 4.1% increase. Redfin suggests that home prices will remain stable, showing no significant challenges in 2024, and Wells Fargo pretty much aligns with CoreLogic, predicting a 2.5% increase. Overall, the consensus among these institutions is that home prices are likely expected with a slight growth this year. No significant surges or dips are anticipated. The expectation underscores the belief that the housing market's dynamic will predominantly be shaped by the interplay of supply and demand, further influenced by mortgage interest rates and the overall economic environment. The general sentiment indicates that while no dynamic movements are expected in the housing market, slight fluctuations will occur as a result of these fundamental factors. Acknowledging the current state, it's clear that the housing market is less affordable than it has ever been. And I understand the perspective of those predicting a market crash. Indeed, there seems to be an inevitable adjustment on the horizon. Either home prices need to decrease or wages need to rise to bridge the affordability gap. However, this adjustment is expected to unfold gradually and not instantaneously. A key concern rises with the potential shift of Federal Reserve's policy towards more accommodative monetary measures, including increase of money supply and decrease of interest rates. Such actions could inadvertently lead to further escalation in home prices, exacerbating the affordability crisis even more. This scenario underscores the complex interplay between monetary policy and housing affordability, highlighting the delicate balance needed to address these issues without creating additional challenges. So there you guys go. Leave a comment down below. Send me a message. I want to hear your opinions on what's going to happen this next coming year. Until next time, Joel with Real Broker.